We're speaking now with Arnab Banerjee, Managing Director and CEO at CEAT. Mr. Banerjee, thank you so much for joining us this morning on NDTV Profit. Absolute pleasure to have you here. Yeah, and we're speaking at an interesting time for the industry and especially tyre companies in focus because of the price hikes that have been taken. Let's start with that bit. The hikes, I believe, in radial tyre prices, raw material prices are also up. How do you see this situation evolving?
Yeah, post Q4 last year, we have had sharp price hike in raw material. Q1 and Q4, the raw material hike was about 5%. Then Q2 and Q1, again, about 4-5% raw material price hike has happened. So the finished good price hike has not been commensurate with the raw material price hike. You saw our margins contracting in Q1 to 12%. And the same trend continues. So margins will be under pressure in Q2. And we expect the raw material basket to even out in Q3 and may moderate a little Q3, Q4 onwards.
What is the quantum of price hikes that have been taken, Mr. Banerjee?
Yeah, it's different for different categories. The trucks, radial and passenger has been more aggressive from our side, about 4% plus, but not so in some of the other categories. OEM price hikes come with a lag of a quarter because most of it is indexed. So that's also inadequate. So overall, if you take the basket of price hike, another 2 to 3% price hike is required. And we may take about half of that in the month of September.
So you've got about a 1.5% increase in price hike or increase in price for tyre companies expected as early as this month. Mr. Banerjee, hi, it's also Samina joining in. While I do understand that the key raw material for a tyre company like yourself is rubber, and rubber prices have been extremely volatile, and there's been constant conversation and talk about how rubber prices are only going to increase from year on. Do you feel like this price hike that you're going to undertake in September could negate the increased rubber prices on one hand, and on the other hand, you've got lower crude prices, which generally garner well for a tyre company in terms of synthetic tyres at least. How do both of those pros and cons play out in terms of margin impact?
Yes, India is rubber deficit. So hardly 60% of the requirement of natural rubber is produced inside the country. There is always a price arbitrage between domestic rubber prices and international prices. However, this year, this difference has gone on to be too high. About 30-40% higher is domestic rubber, which is seldom seen. It is at a 15-year high. Availability of rubber has also been patchy. Now it's kind of evening out. This kind of volatility is not seen regularly. If the prices are flat, albeit at a high level, we can manage the margins through appropriate pricing measure. Coming to crude, yes, crude is trending down. However, the crude intermediates, which lead to other raw material baskets like synthetic rubber, like fabric, etc., are yet to moderate. So if crude stays at these kinds of level, a significant part of the RM basket will trend downwards in Q3.
Banerjee, that's fantastic to know, because we've always tried to understand the connection between the two and going beyond a stock market reaction. Possible to quantify for me, if crude stays at these levels, like you said, it could significantly reduce your raw material costs. Give me a broad range of how much of an impact would that have on margins for you? And that would, I'm guessing, be from the next quarter.
Yeah. So this quarter, already we have seen a raw material basket going up by 4-5% over Q1. So this quarter is almost coming to an end. Next quarter, it depends on how natural rubber will behave, because there are, as you rightly said, there are two aspects. One is the natural rubber and the other is the crude derivative. So if the interplay cancels them out, then we will be at a flat kind of trajectory. If natural rubber comes down significantly, only then the raw material basket will be affected positively in totality. So we have to wait and see which way these two different components of the raw material baskets behave in Q3.
I want to talk to you about premiumization, because that was the big focus for the company in the last few quarters. And I believe it's playing out quite well for CEAT as we see it, at least in this quarter. Looking ahead, how much would you like premium products to contribute to your top line? And would it be a fair assumption for me to make that the premium segment obviously garners better margins? So if you sell more premium tires, it's not just going to improve your top line, but bottom line as well significantly in the next few quarters?
Yes, so if you look at the passenger tire market, the market trends are helping us because 50% of the new car sales today is SUVs. People are buying bigger cars and traveling longer distances. We are moving the brand from a commuter space to explorer space, a long distance traveler space. The Crafted for the Curious campaign, which we have started recently in Q1, is going to see significant investments in various forms and formats across various media channels. That's one. We are launching significantly different platforms like Cross Drive, which will help us go on the highway as well as mild off-roading, like Sport Drive, which is meant for the luxury cars. At luxury end, India is doing phenomenally well in terms of new product launches and sales. So new product development and continuous channel and sales force education. So we are going to invest significant amounts of monies in R&D as well as marketing to change the mix. And as you rightly said, these are margin accretive. And it will take the brand from a commuter space to a premium space where the customer is willing to pay a lot more than a commuter tire.
Mr. Banerjee, just want to get your sense on the thought, and a lot of analysts are saying this about CEAT as well, about how you're trying to de-link profitability from raw material swings. And tell us about the structural changes there that are being put into place.
Right. So if you compare the industry 5 years back or 10 years back, even 5 years back, I think some amount of pricing independence has come into the industry structurally. If you take the passenger car tire market, there are about 7-8 fierce competitors. The market leader has less than 20% market share. So when in such a competitive market, the pricing independence has emerged as a positive. And not just for CEAT, for many of the other players, we can price significantly up or down, depending on our brand strategy and channel strategy. If you take the two-wheeler or the truck bus radial market, it's a consolidated market in the sense top 2-3 players have significant share of the market. There, the independence is still emerging and it is lower than what is there in the passenger car tire market. But overall, as a basket and replacement, I think we are moving towards more pricing independence in terms of competition.
Mr. Banerjee, just changing track a bit, I want to understand how you are seeing the demand scenario. And there's no clear picture there as far as the whole industry is concerned. Passenger vehicles is a different story, looking a little troublesome perhaps. Two-wheelers slightly better. Of course, two-wheelers, you are the leader in market share, etc. But how are you seeing the demand scenario play out? And is there cause for concern as we see inventory levels also build up at dealerships?
I think when you are talking about demand scenario, just now as you spoke, you are looking at the OEM figures, the SIAM figures.
Yes.
Right. So that is where the growth has been flat in passenger, the growth has been flat in MHCV segment, and it has been very good double-digit kind of growth in two-wheeler as they are trying to match up the pre-COVID levels. So it went through a trough and now it's coming up. However, in the replacements segment, it is a completely different scenario. We expect strong single-digit growth in both MHCV as well as in passenger car tires. We expect close to double-digit growth in two-wheeler tires in the replacement segment. The rural market is coming back. In fact, so far, the rural market growth in two-wheelers has been superior to the urban market growth. There is significant amount of sales for CEAT in international markets. About 20% of our sales comes from international markets. There, the order book is pretty robust from various geographies. We are de-risked in international business. It has performed in strong double-digit already. So overall, if you take all these segments, including the slowdown in OEM segments, we are still gunning for a double-digit growth for the entire financial year.
Banerjee, talking about exports, and I know this was last quarter, and bring me up to speed if you've already started, entered the selling to PVs and truck bus radial market in the US. I know it was expected to be launched in the first quarter of this fiscal. And how much is exports contributing to your top line? And because it's a lower base, I'm assuming right now, the potential to grow would be so much more.
Yeah, so as I mentioned, export contributes to 20% of our top line, and it is margin accretive at the EBITDA level. So the more we export, the better it is for the margin overall. And there are three categories
exporting to a significant number of countries. I mean, which geographies are you currently exporting to?
Yeah, our focus markets are three, which is Europe, Western Europe to be specific, US and the LATAM, and Brazil being the largest country in the LATAM. So three focus geographies and three focus categories, which is agriculture radial, truck bus radial, and passenger radial. So it's a 3x3 kind of focus area, and which is what will give the bulk of growth in export. And we want to take this saliency up from 20% to 25% in about 3 years' time. So given our entire growth plans, this means almost doubling exports in 3 years' time.
Mr. Banerjee, good morning. Just one question here. What is the scope of exports looking okay in a world which is slowing down? Parallel to that question is also the China impact, because all manufacturing, because China is not investing in infra, the belief is that they are investing in all things manufacturing, dumping, and reducing end product prices in global markets. Any thoughts there?
Yes, of course. China is a very serious competitor in all these markets, and so is the top 5 brand globally. So we fight competition in a wide spectrum, and in an economy which is slowing down, let's say in Europe, there is a perceptible shift from premium to value brands, and that's where we come in as CEAT. We have got about close to 1.5% share of the total market in Italy. We have got a good legacy brand equity in Italy. Likewise, now we are trying to have good market access in the other European countries like France, Germany, UK, Spain. And this shift to value brand and our small base, I don't think is a constraint for significant percentage growth in exports in Europe, and likewise in US, likewise in Brazil also.
You know, keeping in mind that you're working with rising demand, as you believe, are you at optimum capacity utilization right now? And also, if you are you investing in capex to sort of upfront that for future demand?
Yeah, we have indicated that we will be investing about 1,000 crores this year, out of which about 750 crores is growth capex, 250 is maintenance capex. We won't have a capex cycle as such. That is a management decision. We would like to invest a similar amount every year. So around 1,000, 1,100, 900. Last year was 860. This year is 1,000. Going forward, we will be keeping on investing regularly in capex so that our capacities keep growing. Right now, we are good for 15,000 crores as we speak. Barring truck bus radials, we have headroom for growth in two-wheeler, in passenger, and also investments in bite size are going on in two-wheeler and four-wheeler as well. Our Chennai plant for TBR is coming up for production probably this month itself. So that's where we have capacity utilization at the fullest, but we have enough headroom to grow otherwise.
You know, how do you consider funding these expansion plans? I mean, is it internal accruals? Is it debt? Are you looking to raise funds? Because, of course, expansion always comes at a price. And also, if you're doing this, would you even consider inorganic expansion? Would you consider buying out the smaller players with an increased focus on the export market? It may not be such a bad idea to go out shopping and pick up some of those international smaller players who are maybe currently struggling.
Yeah, to answer the first part of your question, we have enough internal accruals to fund the expansion. Our debt position is comfortable. So when you don't have a huge capex cycle and instead you do bite-sized capex every year, and you maintain a profitability in a tight band, I don't think funding will be an issue going forward. It's not an issue right now as well. Coming to the inorganic growth question, we don't have anything on the plate at this point of time, but are we open to looking at it? Yes, we are. All
right. Thank you so much, Mr. Banerjee. That was Arnab Banerjee there, Managing Director and CEO of CEAT. Says that, the replacement part of the business still seems very, very robust. Remember, that's over 50% of the revenues come in from replacement as well.